Welcome back to another episode of the Me and Money podcast. Elliott, what are you ready to talk about today?
Ready to talk about investments in indexing, or indices, which we don't talk about investing too often today. So I'm going to start this off with a disclosure of none of this is investment advice. Consult your own financial professionals, and I'm sure we have more of a disclosure at the end. But we'll talk about some things in generalities. None of these are recommendations.
Yep. Way to get the pain in the butt words out of the way. But yeah, I'm excited to talk about this. I think it's really interesting. I'd love to go back in time, like, I don't know, 25 years ago, like for people talking about index investing. Like, I feel like individual stock picking was a lot more of a thing then. But yeah, so why don't you start us off, like at a broad level, like we're not going to get into the different types, but what does an index do? What is it?
Yeah, I like to think about this, and I'd be curious your definition. I'm sure there's a better definition out there, but it is a collection of companies that are selected based on a specific criteria that represent a certain segment of the market. So we'll dissect that down a little bit further because I think a lot of people are familiar with the S&P 500 as an index. It's not the 500 largest companies in the US, but it's 500 of the largest companies out there that are included. And there's certain market cap, meaning how big the company has to be, certain number of positive earnings, and other criteria to actually get selected into it.
Yeah.
What would you add or subtract?
Yeah, I would say, it's kind of like a guideline, right, of whatever you're trying to measure, right? So like you said, there's market cap weighted, there's market size, company size, there's industry indexes, there's, anything that you want to compile into a basket, right? Like, I guess you could technically call it an index, right? So, I think it's just, they're broader indicators of what is happening in a certain segment of a market, and what that certain segment of a market is I guess at the beholder of the index to say what they want to track, right?
Yeah, and I think that's a really important thing of what they want to track, because if someone says just buy the index, which I feel like gets thrown around a lot online and in conversation sometimes, what index are we talking about, right? Are we talking about just US companies, the largest US companies, international companies, like world weighting, just technology in stocks or an index? There's lots of, you can get very specific niche indices out there that track. I mean, I think there's actually it's probably not an indice, but there's certain investments out there that just track one or two stocks. There's others that might track 10 or 20 or 30 or 10,000, right? If it's a world stock. So I think that's just an important distinction as we talk about this, that there's lots of different indices out there, and even different indices for the same sort of
index
selection. Yeah, for the same sort of selection, right? If we talk about the S&P 500, there's a lot of different providers that provide different indices, right? Vanguard might have their own that track a certain selection. iShares or BlackRock might have their own, and Russell might have another. So there can be the same ones tracking the same sort of style as well.
Yeah, and I think that's really important, especially in the day of Reddits and finfluencers and all these other sources of information out there. And I think we joke about this, internally as a profession, like, just because you're a CPA doesn't tell me anything about what you do, right? For your clients. But the same is true for an S&P 500 index fund, right? It may actually just reflect how the S&P 500 is weighted, or there could be equal weighting where every company in the S&P 500 is, the same exact percentage of the fund, but you kind of have to dig into things, right, to actually understand what it is you're buying. So that's why there's no investment advice here today, right? Do your research, just understand like what it is you're getting into, and there's always going to be some derivative of what the index is that could be sold as a product, right? And that's kind of the confusing thing about it. Like, it's awesome because it makes investing more approachable and a bit easier to manage if you are just, doing monthly buys in your Roth IRA or whatever. But at the same time, there's still a lot of complexity that I think the average person just doesn't think about.
Yeah. I mean, what are the pros of, I mean, you hit on this at the beginning, sort of go back 30 years. There's a lot of active investing. What are the pros of some of the index investing today? And then maybe we'll talk about some of the cons as well.
Yeah, I mean, I think the obvious one is just access to markets, right? I mean, that's really the invention of the mutual fund, right? To go, I don't even know what it would cost to go buy one share of everything in the S&P 500, but it's not a small number, and most people probably can't afford that on a monthly basis, right? To go buy one share of everything, let alone like weight it appropriately.
Take a lot
So
of time and energy. Even if you could afford it, it'd take a lot of time and energy.
yeah, well, I mean, some people are doing direct indexing, but that's probably a episode and a beast for another day.
Sure.
Yeah, I think access is a big one. I think too, just like the ongoing, like you said, time commitment of managing it, right? So if things are changing in the S&P 500, if it is truly tracking the index, right, there's going to be fund managers behind the scene doing that for you, so you don't have to be trading like multiple times a day, probably, to do that. And then I think at the same time, like just the cost of that, right? Like if you that's where we were probably back in the 70s and 80s, where people were paying brokers like massive commissions to be trading all the time, and you had to pay $20 to trade a stock, and all of that has really, I think, led to the fee compression of funds and automated investing. So I think those are some of the obvious pros. What would you say, or what cons might you have?
Yeah, for me, the pros are low cost, tax efficient. I mean, how incredible is it that you can throw $100 into something and buy thousands of stocks from around the world, and it costs 0.03%, 0.05, 0.1, or maybe even free. There's some funds out there that do that. I wouldn't necessarily suggest them, just because there are some pitfalls to that, but they do exist. So I think that's a pretty incredible thing. In terms of cons, I think as more of these indices have come out, there's more of it. There's more ability to make a portfolio more complicated than it needs to be, right? Sometimes I look inside investment portfolios, and even from some of the big names out there where it's got like 25 different funds, but you're not, there's sort of diminishing returns in terms of diversification versus the added complexity there, where you add 10 funds, but you haven't really improved your results in any meaningful way, but you're definitely introducing complexity to the portfolio. So for me, that's one I see frequently. There is, it is a little technical. We don't have to go into that, but I think it's important in the context of maybe the SpaceX investing, right? There's some people who definitely want exposure to SpaceX, and there's the people who don't want exposure to it. And with an index, if you're not creating your own, you have to accept whatever the stocks are in there, which that can be a pro or a con depending on how you look at it. But I think also there's a pro inside of that you're not choosing investments. So the ones that do better, and research has shown it's a very small sliver of stocks that actually end up driving most of the returns. When you own the index, you're going to get that return. Whereas if you start doing the equal weight or excluding stocks, that sort of thing, you might pick some of those winners that contribute the majority of returns.
Yeah.
So, and you're going to get the pricing on whenever those funds are added or subtracted. This is a very minor thing, but a lot of these funds will do a quick technical, get reconstituted on a certain day every year. Some individual investments get added, some get kicked out, and that can do some funky things to the pricing depending on the size of the stock and what trading looks like at that time of year. Just because if you add, say, a smaller stock or a stock that's not traded as frequently, and all of a sudden all funds out there have to go buy that stock on the same day, it's a very like supply and demand thing, right? If everything wants that, the price might get a little artificially inflated when it's added. Very minor thing, not something I'd ever worry about, but just sort of along the conversation of you have to accept what's in the index for better or for worse.
Security prices never get overinflated on their initial public offering, do they?
Never.
Never. Joke for those of you who might follow the stock market a bit more than others. Yeah, I would agree with a lot of those. I think too, like, I think there's like this false trap or false sense of security, I should say, of, buying a variety of indexes and thinking I'm diversified now, right?
Yeah.
Because a lot of those index funds are going to contain similar things. And again, I think this is where it really gets magnified if you're not truly following like the actual weighting of the index. Like maybe you have three index funds and they're all weighting 10% of their holdings to Nvidia. And now all of a sudden you have 30% of your portfolio in Nvidia. And I don't think a lot of people set out to do that. You know, if you were to look at hindsight, right, you'd probably be happy with that decision. But we don't know what's going to happen next, and you could very much regret that. I think, too, you know, a lot of times there's just a lot of confusion around like what exactly these indexes are and what that means you're exposed to. Like I've had clients say like, you know, this, we don't have a NASDAQ index fund. Like we don't have any exposure to the NASDAQ. I'm like, yes, we do. Like there's companies in there. I mean, that's on me just to do a better job of explaining like what's going on. But that's something too, where don't just take it at its face value. And especially if you're buying like 5 different US equity indexes, like you're going to have a lot of overlap there. And that's where I think some of the VOO and chill, you know, attitude on Reddit and a lot of the social media where, hey, I can just dump this in an S&P 500 fund. It's like, yeah, it's been historically a really good decision over the last, you know, decade and a half. But if you look at how U.S. equities have performed against international and emerging markets the past couple of years, especially, like you've been missing out on some of the best returns in all markets. Again, not investment advice, but it's something where not thinking about what's really going on, right, globally in the investment world versus like, I'm all for simplicity. And if that has helped people invest consistently and confidently, like great. But at the same time, you just know where the pitfalls are and where the traps are and just being so simple.
Yeah. And I think we're both in agreement that international diversification is important. If you look at the total stock market universe, North America or US is only about 65% of that. So if you're excluding developed international emerging market stocks, you're essentially excluding 35%, give or take, of the total world. And just philosophically, like I want to participate in the profits and bright minds of people from across the world, not just in the US. But if you are owning, say, 5 US companies, I think, you know, if you're listening to this, this is where you don't have to be technically inclined to figure out what's actually inside of these. You can go to a site like morningstar.com, put in the ticker, and then go to the portfolio section and see what are their top holdings. And, you know, if it all starts, you know, I have on my other screen here, because you mentioned VOO as an example, right? NVIDIA right now is 7.89%, Apple's 7.04%, right? If you start seeing that across all your 5 different funds, that all these companies are overlapping, you're essentially probably not getting a lot of diversification. There might be some benefit, but if all those companies are all the same, maybe think twice about that.
Yeah. Yeah. And 2, I mean, you know, indexes they're nice to, I think, just understand like directionality of your portfolio and how it's performing relative to other things, right? So again, that's why we benchmark against indexes, but I don't think that trying to track or beat an index is necessarily the right frame set, right? It's more, again, go listen to our episodes about investment policy statement, like long-term investing horizon. And you may, quite frankly, depending on how or where you're investing this money and what those funds are for, you may actually not want to follow the index, right? That's where if you have, you know, money that you're hoping to use in the next 3 to 5 years, like there's probably an argument to be made not to have that money invested at all. But if you're in a less aggressive portfolio and you're, you know, lagging the S&P 500, like that actually may be the successful approach, right? Because you also don't have the risk of the S&P 500. And so I think just the end all be all, like how are you doing against an index really doesn't equate success. It really depends on what your definition of success is. And you could jumble together any index and say, you know, this is successful, right? It's just the story you're trying to say and tell.
Yeah. And maybe in your case there, you're targeting a different index. Maybe it's a short-term treasury index or a short-term corporate bond index or something like that, where your money is actually tracking an index. It's just not a stock index. It's a bond index of a different variety.
Yeah. I think one other pitfall with, you know, watching or, using the index as gospel is, like you said, there are criteria as to why these companies land there, and those companies do change over time. You were just saying, before the call that Google or Alphabet, whatever they're calling themselves today, right? They are actually going to be replacing Verizon, right? So there is
in the Dow Jones.
In the Dow Jones, yeah. And there is somewhat of a, survivorship bias, I guess, to those indexes where it's really easy to look back over 100 years and say, if you would have just held the S&P 500 for 100 years, like your $10 would now be, 100,000 or whatever. But at the same time, like if you're not really taking into account that some of the original investments that were in that index no longer exist, right? It's just kind of a skewed data number, I guess is what I'm saying, right?
I kind of like those numbers though, because it does.
Well, I do. I'm not disagreeing with the logic behind it, but you know what I mean? It's like if you're trying to track an index, right, with your personal investments, and the index is theoretically changing over time, like you too have to make those changes.
Sure. And I guess that's why I like the index, is because the companies that are doing well, they're naturally going to make up. If it's a market capitalization weighted index, they're naturally going to rise to the top and be the better performers, and the bad performers or lower performers are going to naturally go to the bottom. So, yeah.
Right. But I guess where I'm going with this, though, is like the index doesn't tell the whole story of.
Yeah. You can't simply buy the stocks that are in the index and say, okay, those are the best, or like, I'm only going to buy the top ones because the top ones
too. Change. If we look at recent history, right? Like I should have done maybe a little more research before this, but I'd be really curious to see like what the industries of the companies leading the way back in like the 80s and 90s were versus
it's
today.
Changed a lot. There's
it's very much tech heavy now, right? And that's where you hear like the Magnificent Seven, right? Or FANG, they make up such a large percent of like the S&P 500 right now. And I just saw something on the internet from a reliable source who highlighted that the Russell 2000, which is the smallest 2000 of the Russell 3000, is up about 26% this year, whereas the Magnificent Seven or FANG are down about 7.5%. And that's where, if you look at the S&P for the year, right, it's lagging behind a lot of those other indexes because so much of it is comprised of the FANG stocks, right?
Yeah, for sure.
So I just think it's interesting, like because what people view the S&P 500 as today, like those aren't the companies that have been generating that 10%, historical return for the last 100 years. It was a very different subset of companies. Yeah, because a lot of the companies that exist in there now weren't even created in the last 50 years, right?
Yeah, there's a good visual. I'll see if I can find it for the show notes I saw a few years ago of a graphic of those changing companies or industries throughout time. So you could see how it started and then every year sort of how it shifted in terms of weight. And it's hitting on your exact point, but visually.
Yeah. Yeah. So what else would you have to say? I mean, just about general concepts, ideas around indexes.
I think the only other thing I would sort of put an asterisk on that if you're like, maybe we've talked about this, I forget, environmental, social governance or ESG investing. I know it's less popular today, but there's still a subset of the population that really likes it. And I think it's a values conversation, but that's a good example of where maybe you don't want to take the index or you like the index, but then you want to screen by additional factors to overweight companies that are doing well, supposedly environmentally or socially or governance. And I say supposedly just because a lot of this is company provided data or third-party providers, and it's sort of a gray zone of how useful as it is. And you also get some conflicting things where maybe it scores really well on the environmental side, but it doesn't do as well on the social governance. So it just, again, it's a values conversation of like, what is the most important to me and how am I screening these companies? And it's whether you're creating it or a third-party provider is creating that.
Yeah, that could be a whole nother can of worms. The only comment I'd make on that is like really, really understand like how the screening is being done and what the screen is. I'll never forget, I had a client, this was at the last firm I worked at, but they had like a vegan top 100 like ETF or whatever, and it was literally the top 100 companies of the S&P 500. And like
Oh,
how they came to that conclusion like was more just this fund company said, oh, they do like pro vegan like initiatives within the company. Like what that means, I don't know. Like I don't know what Microsoft is doing like to support vegan lifestyle, but just be really careful with that stuff. And I think it's because it is a values decision, right? Like
yeah.
if you actually care about this things, like make sure you're doing your homework and understanding like what you're actually investing in, because the wrapper, on the fund doesn't really tell the whole story. Don't judge a book by its cover.
And again, it's complicated, right? You have
Yeah.
some energy companies that score well environmentally because they are investing a lot in solar or wind, but they're also extracting oil. So
Yeah.
it's a hard thing to sort of get your head around. What else would you
Yeah.
have for indices?
I mean, again, I think they're really good. Like if you are using them to monitor your personal investing, like make sure you're choosing appropriate indexes or indices to benchmark your investments. Like if you have, a 60% stock, 40% bond portfolio, the S&P 500 is not a good benchmark for that, because it is 100% equities. Like it is good to compare if you have like a mix of funds and you have some equity funds in there. It may be a good benchmark for those funds specifically, but not your global portfolio. And to that point, like don't let what the index is doing like make you chase returns, right? Because again, the way an index is comprised may not be how your assets should be comprised, especially when it comes to cash management. So I think that's kind of where I would wrap that one up. Just like a general word of caution.
Yeah.
Don't get FOMO from the indexes.
Yeah.
Right.
Which comes back to diversification, right? We don't want everything going up at the same time. We don't want everything going down at the same time.
Yeah.
Oh.
Awesome. Well, I think that's a good primer on it. Maybe this is a topic we'll continue into the future, and just we don't talk a ton about investing, but it might be fun because there's a lot of surely headline moments coming up this year with the stock market. So
Sounds good, Matt. Thanks for a good conversation.
yeah, good to see you, Elliott.